one of the most enduring puzzles of the Ukraine conflict has been interpreting the state of the Russian economy and its ability to wage war. 2 years after the special military operation and thousands of sanctions later, President Putin and his team of credible finance managers, led by Elvira Nabiullina, who's head of the Russian Central Bank, have found a way to circumvent the punitive measures that are sanctions. For all the frozen assets and thousands of sanctions, the International Monetary Fund (IMF's) later forecasts about Russia's economy project a GDP growth of 2.6%. Russia's own figures report an even higher growth at 3.6%. Interesting, right? But what's even more interesting is that these forecasts only tell half a story. Some of the common ponderables that permeate scholarly debates on Russian resilience, despite these strident sanctions, center on two factors: reliability of data sources and data interpretation. And we'll return to that shortly. But before that, let's quickly view Ukraine's economic situation as well. The matter of Ukraine is pretty straightforward. The country is totally dependent on Western macro-financial, military, and humanitarian help. The cost of rebuilding the country whenever the war ends has been pinned at least $1 trillion. But what's happening with Russia? It is now the most sanctioned country in the world, with 19,000 sanctions against its different entities and individuals. Despite Western penalties and the rising costs of an already expensive war, the Russian economy has managed to show resilience. This becomes even more prominent as Europe's biggest economy, which is Germany, has shrunk by 0.3%. Let's first deconstruct the IMF figures. The growth figures released by the IMF for Russia look optimistic because they are now driven by the war in Ukraine. In other words, Russia is now a wartime economy. Moscow is now spending an unprecedented 40% of its entire budget, which amounts to almost 6% of its GDP, on revitalizing the military-industrial complex. With more people working in the military sector, there are better and more wages, which has hiked both employment as well as consumption. It is the first time in modern Russian history that spending on defense is going to outstrip social expenditures. The obvious takeaway from turning Russia's economy into a wartime economy is the cardinal importance that President Putin has attached to this war in his larger political aims. He has staked almost everything on this war. But those who know and understand economics better have been cautioning that the Russian economy is in overheating mode and the current growth trajectory is not sustainable. It's not just about deficit financing. The reasons are more fundamental that I'll tell you in a while. Before we get there, let me explain this web of sanctioned maze against Russia. So before the war began, Putin had built an impressive war chest with $640 billion in foreign reserves that came from the unshakable and decades-long dependence of industry-hungry markets in Europe. Hydrocarbon revenues were the magic wand that had led Russia to fill its coffers with tremendous foreign exchange. Therefore, when the war started, the two most evident sanctions from the West were aimed at denting Russia's energy revenues, those already earned in the past as well as those anticipated for the future. For the former, the West announced freezing half of Russia's foreign reserves that were held in Western banks. And for the latter, it announced harsh sanctions. Russia turned off the taps for its natural gas to Europe in retaliation. Soon, Russian crude oil and refined oil products were sanctioned by the West. But energy, especially oil sanctions, had to have a safety valve as well. Why? An added challenge there was to ensure that this geopolitical upheaval, by which I mean cutting off Russia from European energy markets, didn't trigger an uncontrolled price rise of Brent crude, which is the benchmark. Therefore, the oil and refined product sanctions came coupled with a G7 price cap of $60 per barrel. This price ceiling ensured that Russian oil flows to the rest of the world, though under the price cap. Now, the price cap has been a matter of speculation and heated debate. Some have argued that its initial phase was instrumental in lowering Russia's oil revenues, but its efficacy dwindled as Moscow acquired a shadow fleet of tankers to transport discounted oil without adhering to the G7 price cap to new markets in China and India. Therefore, a popular conclusion drawn from the above was that energy sanctions on Russia had failed. Because despite all the restrictions, Russia was still able to reroute and sell its oil and even earn revenues. I'm sure you've heard such arguments many a time. But the problem is that such conclusions derive from armchair intellectualism that doesn't really delve deeper into interpreting data. When you delve deeper into data, you get a different and a more complex picture. The best way to probe into the performance of the energy sanctions is to delve deeper into the data provided by none other than Russia's Ministry of Finance itself. What it does is that it furnishes a better picture of its revenues with insightful takeaways. So, to the question, have the energy sanctions been successful? The short answer is yes. Data from Russia's Ministry of Finance shows that when compared with the oil and gas revenues earned in 2021, which is before the war, the figures have dropped by 65% in 2023. So in figures, Russia earned 25.29 trillion rubles in all of 2021. Despite the rise in crude oil price after the war began and the successful rerouting of hydrocarbons to newer markets, Russia's revenues have been following. And you know how much? The 8.8 trillion rubles earned in 2023 is 24% less than 11.5 trillion rubles earned in 22 and 65% less than the revenue earned in 2021, which was 25.29 trillion rubles. So the fall from 25.29 to 8.82 in merely 2 years of war, despite a surge in oil prices and successful rerouting, is because of the sanctions. The sanctions were not only successful in lowering Russia's energy revenues, but also kept the price of oil rather stable throughout. It also shows that the country is likely selling its gas and oil at steeper discounts to China than have ever been disclosed or will ever be disclosed. So, if not from oil and gas, where is Russia earning its revenues from that its GDP is showing this growth? Now, for that answer, let me again take you to figures from Russia's Ministry of Finance. When non-oil and gas revenue figures are analyzed, the picture obtained is quite the opposite of the oil and gas revenues. While oil and gas revenues have fallen, non-oil and gas revenues have risen after the war. So between 2021 at 9.9 trillion rubles and 2023 at 20.3 trillion rubles, the non-gas and oil revenues have risen by a 124%. For a holistic picture of Russia's revenues as an export surplus or deficit, all one has to do simply is to add the total revenue for the 3 years of 2021, 22 and 23 to give a picture of before and after performance of Russia's economy. In 2021, the revenue figure stood at 34.5 trillion rubles, but 2 years later, this figure has fallen to 29 trillion rubles. Of course, the shortfall in the oil and gas revenues is made up by the remarkable rise in revenue in non-gas and oil segments. However, there is one fundamental problem with this analysis. One doesn't know what really is driving the 124% increase in the non-gas and oil revenues after 2021. Usually, these are taxes and revenue from other means. But for a hydrocarbon-based economy such as Russia, the government has not disclosed the details of this category. At best, it remains speculative. Add to it the fact that due to payment issues and falling discounts, India is again buying from more traditional importers like Iraq. Now, these factors do show that the revenue pattern for Russia's traditional magic wand is going to remain rather precarious. What about other economic parameters? Let's analyze a few more. Now, the price of ruble, which is Russian currency, when analyzed over a 3 to 5 year period, has been falling as well. Before the war, it was trading at 75 rubles per dollar. After the war, it fell to 130 rubles per dollar. Now, the Central Bank of Russia has been a savior because it has stepped in repeatedly to stabilize the price of ruble through different capital controls. But towards the end of 2023, the price fell back to $100 and it's now more or less at $90. A small monthly jump here and there doesn't change the fact that the ruble has been devalued after the war. In fact, one of the reasons that has pushed up export revenues is not the sale per se, but the devalued ruble. But that's not the biggest problem with ruble. Lack of transparency in its real exchange value remains one of the reasons why India, for example, is unable to start the rupee-ruble trade with Russia despite all the political will on both sides. Now, Russia has reportedly paid Iran for Shahed drones, not in rubles or yuan, but in gold. Considering the lack of transparency in its exchange value, it is quite convincing that Iran may have actually preferred golds. All this shows that Russia has an import problem, especially when it comes to making or accepting payments despite importing from China and Turkey. Russia's imports of war-critical goods, among other trade flows, have been quite volatile. Going further, another problem is the FDI. Foreign direct investment in Russia, which had been declining since 2019, saw a steep rise in 2021. While in 2020, it stood at $9.4 billion only, it jumped to $40 billion in 2021. However, after the war, it plummeted by a staggering 206% and came to a minus $43 billion. The interest rates, on the other hand, still remain sky high at a 16%. So what is the political interpretation of all these figures and patterns? Among many of his election speeches, President Putin has assured that the economy is developing, which technically is a fact, and that this will enable Russia to sufficiently transition away from the West amid the sanctions. However, a detailed analysis of data generated by Russian sources shows that this cannot reflect broad economic recovery or sustained growth unless the energy revenue, which was Russia's traditional stronghold, is able to sustain and Russia is able to attract FDI. But again, it is not the same as saying that the sanctions are capable of choking Russia's ability to finance the war. They are not. The real challenge before Russia is to turn its current resilient GDP growth, which is driven by massive spending on the military-industrial complex, drawn from its remaining reserves, dwindling oil and gas revenues, and undefined but rising non-oil and gas revenues, all of that into a sustainable state program that fosters industrial development in other areas as well. The path ahead, needless to say, remains rocky. Whether Russia will be able to channelize the growth from an overheated war economy into a sustainable state program remains to be seen. Now, how will that impact India and Russia trade, where the two countries are trying to resolve payment issues, a huge trade deficit, and efforts for diversifying trade engagements? I will be back to discuss that and more. Stay tuned.